Welcome to Reality Podcast. I am your host, Gary Scott, and today we have first my good friend, but also real estate expert from the Triad in the High Country, Mr. Tony Jarrett. Tony, how are you?
Good. It's good to see you.
It's always
Having
good
fun in this winter weather up here.
It's always good to see you. Hopefully, by the time people listen, they will have thawed out. Just as a frame of reference, we are between snowstorm 1 and what I read is snowstorm 2. And so first, I hope everybody is staying safe out there. This is the most widely listened to reality podcast. And what we decided this past year in 2025, Tony, as you recall, is every quarter, you and I would just talk about the previous quarter and a little insight into what we think next quarter. So I have to tell one story and then we're going to get rolling into things that are important. Inventory, interest rates, days on the market, month supply of inventory, baby boomers, mortgages, all of those things. After our last recording, Tony said to me, Gary, don't you want to have other guests, report back on the quarterly? And I said, no chance. I said, we are on a run of the most widely listened to reality podcast. And if nothing else, our audience knows that you and I enjoy each other's company. We're passionate about our business. I know we're optimistic about 26, but let's kind of dig in. You know, you are a guy that spends a lot of time really looking at the empirical data and share that with our audience. So first of all, what trends did you see at the end of 25 that may or may not move into 26?
So there's so much to talk about. I will tell you, looking at all the regions that we serve, one of the trends that came strong through 2025 was listings, more for sale signs. So the fourth quarter, it slowed down just a little bit, but it was still over year, probably 15 to 25% year over year gains in for sale signs. I get a lot of questions of, tell me what's consistent everywhere. And that is one of the things that was very consistent. I do believe that's going to carry into the spring market this year. And I would bet we're going to have more properties come on the market.
So let me piggyback and ask a follow-up. One of the things Tony said is, what is consistent across our footprint? Now, for our listeners, we have them from really all over, but we got North Carolina, South Carolina, Georgia. And then we've got Virginia. And so our data that we're going to share is going to be specific to the markets we're in North and South Carolina. But I want to make sure everybody understands that a lot of that will lay over into another market.
Right.
But as Tony said, in order to be consistent across multiple markets, we always have to remind ourselves the market is hyper local. And I share that as we continue to have conversation, Tony, because of the incredible importance of staying crystal clear away from the national media.
Right.
And we'll come back and talk about how the national media, as a matter of fact, you and I have had some fun in the past on fact or fiction, perception, reality. Tony, there's a concept that has been written about called delisting. And you put it in your notes. I think you called it, I think you called it a failure rate. So let's just talk a little bit about what a delisting is and what does that indicate, what opportunities that it might present for a seller now. So walk us through that if you don't mind.
Yeah, so I've always done consistently the 5 stats. This year I've added the 6th stat, which is failure rate. It's a new one. We haven't seen it in many years, and there are some different levels. So one level is delisting. So what is delisting? It means the seller just decided to take the house off the market. I didn't get the price I wanted. I didn't get an offer. I didn't get many showings. Whatever the case may be, I just decided to quit. And so what we're seeing is that typically is an expired listing, a withdrawn listing. In the United States, our good friend Dave Childers says that's a 55% rate in 2025. Now think about that for a second. Across the country, 55% of all homeowners just decided to pull their house off the market. Now, I will tell you it's not that high in the Carolinas, but it is high. And what I would tell you is what I'm tracking in, and I looked at two examples is the Triad region and the Triangle region. So the Greensboro, High Point, Winston, and then the Durham, Chapel Hill, Raleigh market. That was between 30 to 40% of every listing in 2025 came off the market because of that reason. So you could safely say 1/3 of all sellers just quit for whatever reason. Now, it doesn't mean they won't come back next year, and maybe they will this year, in 2026. But the reasons are why. I will tell you that there are layers of that. We're pushing in those two regions, almost 40% had a price reduction. So probably the number one reason is I didn't get the price I thought I was going to get. And I will tell you that it's the hardest job we have today is getting properties priced right to hit the market, because we do have such price appreciation over the last 4 or 5 years from the COVID. And that's another stat we'll talk about that's calmed down. But we do have some sellers that just maybe are shooting for an unrealistic number. And maybe we can't get that number because their neighbor got it back in 21, 22, or 23. And now the market is speaking differently. And it's created a failure rate of inventory that was sitting there, and now it's come off the market.
I'm going to piggyback off a stat you gave, and it was specific to the two markets you indicated, which was 40% of the active listings had a price change. And what I want to do is provide a little perspective, because when we looked at that data just 6 short months ago, it was 32%.
Yeah.
And so it's moved into the 40s. And as Tony said, 55% had come off the market. Now, we'll also talk about, as Tony said, there are still more homes on the market for sale today than were a year ago, 2 years ago, 3 years ago. I think with that data, which is one of your 5 stats, we also have to talk about month supply of inventory. And I know you've done a great job, Tony, of breaking that down by region. Again, a reminder to everyone listening about the importance of understanding that every market we're in is hyperlocal. And we've got to educate ourselves on the market that we are talking about when we're with a buyer or a seller. And we've got to stay very clear from generalizations. The more specific we can be, the more empirical data we can draw, the more specific examples we can give is going to make, to your point, it's certainly going to make the pricing conversation one that is less emotional and more intellectual, which is really what we have to do better in 26 than we've ever done, is provide empirical data and not, hey, it's my opinion, Tony, Jarrett, seller. Here's the data, right? So let's jump a little bit. Let's go ahead.
Before you do, I want to give the audience another failure rate.
Yeah.
And that's on the buy side. So typically we have what I would call a healthy failure rate. There's going to be a number of deals that just don't go through because of whatever reason. Typically we see that around 8%, meaning that closings, you get under contract, 92% of the deals should always close successfully. But why does 8% not close? Typically it's an appraisal, a mortgage issue, and then there's property condition and inspections, that repair request. And then there's that last one, which is just buyer's remorse, where a buyer may just change their mind. And it's rare, but sometimes we've seen sellers change their mind.
You're right.
So with that being 92%, I will tell you it's starting to track up higher this year, especially in the second half of 2025. We saw in the Carolinas it inching up to 10%. And some like your hyperlocal down to about 12%. And the question is why? Well, let me tell you what it's not. It's not appraisals. We're not seeing appraisal issues. We're also not seeing a lot of mortgage issues, meaning credit scores. And that's kind of cleaned itself up. But there are two that I'm really seeing. And one is the property condition. We're seeing a lot of sellers put their house on the market and they haven't touched it in years. And the idea is that you stage the house, you get it looking good, but when the inspector comes out, we start digging and we find some things that have been neglected. Well, that is starting to turn more to probably the number one reason. And that's just as you own your home, it's always good to do a little bit of home maintenance every year. versus waiting on this. And now hopefully the buyer will take it. Well, a lot of buyers today, especially the younger generation, are looking for more turnkey. They want the house in good condition. And it's leading to more buyer remorse because they're just changing their mind. And as the market has become more healthy and we're negotiating more, guess what's dropping? Earnest money and due diligence amounts. Now, I want you to think, guys, when you sold the house in 21, we all complained about how due diligence in North Carolina that was going between 5 to 10% of purchase price. When I came in the business, probably you, Gary, we both were trained around 1% of the purchase price was a safe number. Well, we're seeing that number drop again. We could complain about 10%, but guess what? A $300,000 house, and I give you $30,000. Guess what? I'm not doing. I'm not walking away. But when you give less than 1%, which would be $3,000, we're seeing buyers go, you know what? I'm out of here. And that between the property condition and the low amounts, it's creating a higher rate of failure rate, if you will. So we really are doing a lot of coaching with our sellers around this property condition and negotiation because it's definitely changed, and that trend is really moved quickly in the last, probably the fourth quarter. We saw a lot more of it.
Great stats. A couple things. So when Tony talks about that failure rate, it's also known as the fall through rate under contract. And so the other one that does happen is from time to time, particularly the buyer, but sometimes the seller, in that short window, their circumstance changes. Now, that's a small percentage. So I'm going to give a perspective. As I look back over my career, the highest number I can remember over the course of a year, Tony, is 14%. So Tony said 8 to 10 to 12. So I saw 14. I'm going to take a shot in the dark that it might have been somewhere between 7 and 12, right? As the world really changed. I think the other thing Tony brings up, and again, this is really a reminder to every one of our agents who is spending time connecting with their sphere, who are homeowners. I have said for decades, Tony, how important it is every year for every homeowner to identify, and I always say like 1 to 2% of the value. To invest in your house to make sure that it remains a great house while you live there. You and I have seen time after time where people don't keep up the house, right? When they go to sell it, they do all the work, and then they're like, "Heck, I want to buy this house. I've made it so nice." Yeah. You brought up another really great point, and I used the phrase, "Today's buyer doesn't either have the time or the imagination to go from A to B." And they want to walk in and I'm going to pay this amount. I'm going to put a little bit over here because you always got to do something, right? And so I think that's really an important thing for us to think about. My encouragement to our listeners, I would go to my sphere the first quarter of this year, whether it's my my equity assessment or my home physical or my pop buy. What are you going to do to your house this year? So an example, if I've got a home worth $600,000, every year I got to spend 6 to 9. I got to make sure that that X is in good shape, and I might have to do Y, and I might have to repair some windows, and I might have to make sure my roof is like, don't wait. And you're better off spreading it out, particularly because of the equity that has been built. I will have to share this, and I know you're going to get back to price in a minute. So I actually want to wait till you do that, but I'm afraid I'll forget my stat. But I'm going to take a chance. Last thing for me is I go back, Tony said when he and I were in the business, 1%, it was in due diligence, it was earnest money deposit.
Earnest money,
1%, and another 3 to 4 after the mortgage commitment and after the inspection contingencies were satisfied, right?
Right.
And so to your point, there was only 1% at risk. And so again, the evolution of due diligence, the evolution of post-COVID, really important to understand. You know, what's interesting, Tony, as we come upon March 15th, 17th of 2026, it doesn't seem like 6 years ago.
Yeah, right. No, it doesn't. It feels like another lifetime ago.
Think about that. The other date that I think is fascinating for us to think about is mortgage interest rates, June of 22, which would be almost 4 years ago, went over 8% as a result of inflation at an all-time high of 9.1%. We're going to talk about interest rates. We're going to talk about normalization. We're going to talk about what we think it's going to do to impact our business. But Tony, so let's talk a little bit about days on the market. I think another really one of your most significant 5 stats.
So days on the market, the words I'm going to use are slowly increasing. So they've been slowly increasing all of 2025, but there has been a shift I've seen in the second half of 2025. And I'm going to give the audience 2 days on the market. There's a days on the market that went under contract, a success number, as I always call it, meaning that you listed the property. How many days did it take you to get a contract? That's one market. What's happened in the regions is that we're seeing a second market, which is active listings for sale signs that have not received an offer. And there are 2 different markets. So let me give you a couple of examples. And this is consistent in many of the markets we serve. But for example, in the Triad region, in the fourth quarter, it was 47 days ending the year with a contract. But there were a number of active houses that have not received it. They're on the market for 72 days. Now walk with me. In the Triangle, that number's 57 days success. So that's just a little less than 60 days, 2 months. But the active houses were on the market for 114 days. You see that gap starting to widen, meaning that now you're going to 4 months. And so there's that market sitting there waiting on showings, waiting on offers, and the other ones are getting offers and they're closing. Then I take you up to the mountains, up in Asheville, 59 days sold, but the active 126. I can do that in every single region. And I will tell you, I've not seen this since like 2018, 2019. So we're seeing 2 markets, and it's the market where the sellers are really serious about selling, hitting the market right, not reducing multiple prices. And then there's the other one sitting there fishing. Let's just see if we can get it. Oh, we'll come down later. Let's see. But 2 months to 4 months is quite a difference in success rate when it comes to a days on the market. So that's the biggest trend I've been seeing with that stat.
I'll share with you a stat I pulled up. Again, you got to be careful of your source, but I think that it speaks to this conversation about pricing, right? What Tony just shared is we got like 2 railroad tracks. We got what happens to price rate and what happens to not. And I always say, the median day on the market is much more significant than the average day on the market, right?
That's correct.
And so just bear with me, audience, today. So I picked this up, and I'm not sure it's 100% accurate, but it is directionally correct. The longer the house sits, the less it will sell for. Okay, that kind of makes sense. 0 to 2 weeks, if you get it sold in 0 to 2, you're getting 100% probably. 3 to 4, 99. 5 to 8, 98. 9 to 16, 96. 17 weeks, 94. So think about the data Tony just gave you, compare or reconcile that to what I just gave you, and it supports that, right? Think about this. Over 40% of every active listing in most markets today have had a price change. Like, think about that. 21%, give or take, depending on your market, sold for over asking price. Those data points must be reconciled. What Tony just said is, I think I'll get it wrong, Tony, I didn't make a note. 57 on the ones that sold, 114 that are active listings that didn't sell. And so the other data point that is significant is the national media is putting out a data point that says 53% of people, home is worth less today than it was yesterday. Well, okay. I also read that the average appreciation from 16 to 25 was 72%. It's all about perspective and relativity, right? If I bought then and I'm selling now, I have to reconcile that. If I bought 216, I have to reconcile that. And, the other stat that's amazing is, 40% of homeowners have no mortgage. The equity out in the world is significant. we'll talk a little bit about a stat Dave Childers gives us, which is home real estate values and mortgages, to just show that incredible equity. Equity equals opportunity, Tony. I think equity equals opportunities.
Well, to this, it's really a simple question for our clients, especially the sellers. Which market do you want to be in? Because echoing what you just said, would you like to sell it quicker for more money? Or would you like to reduce your price, take less, and take longer to sell? And those are the two choices. It's really that simple right now in this market.
Let's talk about days on the market as it shifts itself from, kind of throughout the Carolinas, because I also want to really speak to that data point. So let's just talk about what trends you've seen, days on the market, and then not only days on the market, but percent list to sell price. So
list to sell?
Yeah, I'm sorry. You just touched on days on the market. Let's talk about list to sell price.
Yeah, it's also moving slowly. So we talked about days on market moving slowly. List price to close price ratio, again, 2 markets with no price changes. Across the Carolinas, I'm tracking around 98 to 99%. That is, if you hit the market right, it's starting to get to 98. But you remember, go back to 3 years ago, it was over 100 everywhere. I don't think any of us had seen that in our careers. Now it's starting to get healthy again. 98% of what you're asking is quite healthy, if you ask me. Now, when you do a price reduction, that's starting to widen. And we're starting to see more of 95-ish. So I want you to think about this for a second. If you take a $300,000 house and you get 98%, you're going to negotiate somewhere around $6,000. But boy, you start getting to 95, you're talking about $15,000 that you're going to take a hit on. And that is starting to widen again. It's very similar to the days on market, but we're seeing the market starting to show more negotiations happening. And the more risk that you do by going high on your price, you're opening up yourself to more negotiations in those two numbers. But anywhere from 95 to 98% is what I'm seeing from no price to 1 price reduction is the number.
Yeah, so I think that's really an important stat. I think the percent list to sale has always been an intriguing number to me. Because the data draws on the last list price. And if we believe that 46% of every active listing has had a price change, I've always, when I was selling actively, I wanted to know the percent of sale price to original list price. Because that's when I was trying to create my own value proposition. I would always say something like, 80% of every listing I have sells before a price change. Like, one of the things that I'd like this audience today to take away is do what we call a transaction audit of your own business from last year. Go look at every single transaction. Take a look at what you did right, what you might have done differently, but create your own set of data points. Compare that to the market. Because if I'm out in the marketplace, by the way, I've been studying up on some statistics because I think they're impactful. 81% of every seller only interviews one agent. So that is a message to everybody. My question is, how do I become that one agent? Like that's we have to assume we're in competition. Yeah. The reality is, if that number is accurate, and whether it's 81 or 71, kind of irrelevant. But what we know, we have to do something in our business to be that one if that data is remotely correct. And so I want to challenge everybody to know your information. If the market says it's 97% list to sale and I'm 99, that's a value proposition. If I average 0.7 price changes of my 14 listings, I've said this for years now. What is the one thing that a seller wants? There's only one thing they want. It's a result. Mm-hmm. An acceptable result.
Right.
Yes, they want communication. Yes, they want follow-up, follow-through. Yes, they want open houses. Yes, they want marketing and exposure and social media. They want you to sell their house.
That's right.
So as our audience thinks about solidifying their plan for 26, who are you? How do you perform against the market? I also say, how does your branch perform against the market? Now I'm bringing my team with me.
Yeah, I love that because you talked about hyper local. Your own stats are hyper local. So, especially in certain neighborhoods, price points. But, as we're looking at our hyper local stats, we have so many agents who focus on closed comps. And I will tell you what's really resonating more is the active market. So we need to double check ourselves when we're running these stats to see. It's kind of like I was talking about. There's two markets. There's the ones that have already closed, but there's the active market that's telling a different picture right now. And I will tell you, as agents, you really should be looking at that every week. Pick one day of the week when you're looking at your inventory and or your buyer clientele and start watching, because I have seen some things change. Every 30 days, there's maybe a new trend in that hyper local. You really need to be staying in tune to what's happening in that market with some of these stats.
One of the things I did, I don't ever listen to reality podcasts. My kids joke, like, are you driving down the street, Dad, listening to yourself? I said, I don't do that. I don't do that. But I did listen to our last quarter. And we talked about this, Tony.
Yeah.
And what we said was, your competition are the 6 listings in your price point, in your general vicinity. And what we said then, and I'm going to say it today, because number one, as Stephanie Riley reminds us, the rule of 11, us adults need to hear things more than once, is that, my job as a real estate professional would be to come out and list Tony's house. Tony, as part of our journey, I'm going to go show you, get in my car, and I want to go look at every one of our competitive listings. Then I assure you, as part of my plan, I'm going to microanalyze the traffic to those listings, the sales of those listings, and if one of them sells and I find out the selling agent didn't show yours, I'm going to call. Now, I can't promise a return phone call, but I'm going to do my best to understand the why. So right. I'm going to double down on our conversation we had a quarter ago and say to our professionals, more important than what closed last month, the month before, 6 months before, what are you competing with today? And then monitor that at a micro level to help you determine today's market value based on today's buyer, today's interest rate, today's weather, right?
Right.
By the way, a little tidbit for us real estate professionals. As many of you know, my dad was in the business, and every time there was a snowstorm, he said, I thank God I wasn't in the restaurant business, because restaurants lose business. Ours is simply delayed to a sunnier day. So if January is a little not where we wanted it, it's a matter of they're going to buy the house that we're going to buy today. Tony, they're going to buy it February 14th.
There you go.
Valentine's Day. But let's talk about prices. Tony, we talked about it a little bit, roundabout way. I shared a number. You shared some numbers. What are you seeing that happened in the fourth quarter? Probably as important to anybody. What do we think 26 is going to have in store for us from an appreciating home value?
Price appreciation continues to, my words will be normalized and get real healthy. Everywhere I tracked, it was somewhere between 2 to 4% average annual appreciation, averaging out every quarter. There are two messages that I get concerned about the media. I already said that 40% in some markets are seeing price reductions. That does not mean that you're losing appreciation. Those are two different animals altogether. Hitting the market right, and you talked about it earlier, hitting the market right, you should still appreciate. But we're not seeing that 10, 14, 18% noise that we had in 21, 22, but we are definitely seeing it level out, and it's really consistent in most of our regions. So a seller and then I saw something this morning that made me think about this lock-in effect that we've had of the 3% mortgages. I saw for the first time this morning that it's actually reversed. It's gone the other way, that buyers who are sitting on these houses because of this mortgage rate, 6% is starting to normalize that behavior. And so a lot of people are starting to trade that 3% for a 6% because of life. I need to go buy. Family's growing. I'm relocating. You tie that to appreciation, if you said it earlier, if you bought a home 3 or 4 years ago, you're not going to lose money, but you may not gain 10 to 15%, but you should gain something. And that 2 to 4% is probably a very healthy number to think about over a number of years. And most of us, the tenure I saw for the national is 11 years. 11 years is still the number that I'm in my house. And to your point, if I've been in the house 10 or 11 years, I'm going to have a nice equity in that house probably about now and have a healthy average appreciation. But I don't see these numbers changing. I do think we'll continue to stay healthy in this 2026 with that appreciation.
I think the other big number, and I know we talked about this last time, but I continue to remind when I get out to sales meetings, business meetings, Tony, is, if we look at what I bought a house for and what I sold a house for, in my view, the real assessment evaluation of my investment is what I call my cash on cash return.
Yeah.
If I bought a $300,000 house and I put 20% down, I put down $60,000. So if I walk away with 90,000, like I think about my financial advisor, as you know, happens to be my son, I would take that return every day from him. And
right.
So too often we're worried about what happens, like as Tony said, not only are we getting appreciating home values, but we're building equity as we make payments, right? If you remember, the data from 19 to 24 was appreciation would average 57, but equity buildup was 74%. And so I continue to absolutely believe, and I want to talk about this a little bit later, Tony, that it is still a great time to buy a piece of real estate. It is a great time to sell a piece of real estate. Yes, the month supply of inventory is not aligning with what has historically been, I call it the break even, right? The 6 months. You and I have talked the last 3 quarters, maybe 6 months has moved to 4 months just because the world has changed. So interesting. Tony, let's talk a little bit about first-time home buyers. The data says, I think, 21% of every sale last year was a first-time home buyer. The average age of a first-time home buyer was the oldest it's been, which is 40. The average age of a home buyer seller, 61. Let's just talk about that evolution, if that's the right word.
I do believe that there was a generation of buyers that have been sitting on the sidelines waiting on rates to drop. And I think this year we're going to see that move. This is 2026, we're entering at 6%. 2025, we entered the market at 7%. 2024, we entered the market at 8%. You see the trend. So I think in 2026, it's going to be a couple things. It's going to be mortgage rate that's going to move me. 2, it's going to be more options, more inventory to move me. And 3, I don't have the graph to show you, but one of the graphs that's finally we're seeing in the last 24 months is wage growth is exceeding price appreciation. And so when I feel more confident about my salary and prices and real estate are leveling off and I can buy cheaper on the rate, I think you're going to see more first-time home buyers move into the market in 2026. I also believe that we're going to see some local governments. There's a lot of advocating going right now for some first-time home buyer monies trends. I said it in our last one, and I'll say it again. Buyers right now are shopping mortgage rates and mortgage payments, loan payments, more than they are the price. If the house falls to $350, whatever, but I can only pay $2,100 a month, whatever that number is. Where we're seeing market trends succeed is new home builders are really succeeding right now. We talked about it earlier. The condition issues have been a problem. So buyers moving in don't have condition issues on a new construction. And the builder is offering on a $400,000 price, the average is about a $10,000 concession between blinds, appliances, and more than anything, the mortgage, buying down the rate. What we're trying to get our sellers on the resale side to think about, not only condition, but are you packaging a concession? We will get you that price, that 98 to 99%, but you're probably going to have to help the buyer buy the rate down, maybe from 599 down to 499 or 1 block down. There's so many ways to do it. Or closing costs. Help me on the down payment on the closing costs. I do think that's going to start appealing to the millennials who are coming into the market. Help me get into that house financially, and I'll make you a really good offer and a clean offer. We didn't see this 3-4 years ago. And I'll say this is a really important thing. One of the agents told me the other day with what she's seeing with clients, and it resonated with me, is that in 21, 22, when you were up against 4 to 7 offers at a time, there was a lot of emotion. Today, I'm not competing with that many offers. It may be one offer. So buyers are more intentional today and less emotional. Think about that for a second, because 5 years ago, they were more emotional than intentional. And now layer what's getting ready to happen in the market. We're seeing more businesses saying, no more COVID restrictions as far as working remotely. We want you back in the office. Well, I bought that house 20 miles away from the office to get out away from everybody. It didn't really fit my need. I bought it emotionally because I had to beat 5 other people. Well, now I need to get back closer to the office so my commute's not as long. And I don't really like the house I'm in. I actually like the house that's closer to the office because it's smaller. It's got another bedroom, whatever the case may be. You're going to see that trend happen in the next couple of years. Now, I just unpacked a lot right there in those couples.
So this is what I'm going to have Lori transcribe and send our notes back to us. I'm going to piggyback off a comment you made. And for the first time in a long time, there are more mortgages over 6 than under 3.
Yeah.
So like that really speaks to Tony's point. Just I want you to kind of wrap your head around that. Mm-hmm. The other thing that I think is super interesting, and I just wrote this down. Since 1950, Tony, home prices have only declined 7 years. So this concern, and that with 90, 91, 7, 8, 9, 10, 11. So 7, 8, 9, 10, and 11, and we're not going to go through it today, but the dynamic of this market and the dynamic of that market are not they're not even close. And we can go from, by the way, here's a little note to collective selves listening. Be careful when you read foreclosures up 21%. Like I'm just going on the record. When you are 0 or, I think the number, I think I have this, it was in 08 or 09 or 07, it was 2.9 million. And now it's 347,000. Perspective. I think the other thing, it's interesting, Tony, you talked about wage growth. I wrote down 50 things that I find interesting in our business. Number 21, not in any particular order, wage growth will continue to outpace home price growth. That is a win, particularly for the first-time home buyer. I'm going to ask you another question, but this is something I read that I think speaks to a world we live in today. Americans dropped a record $12 billion on Black Friday.
Oh, wow.
We don't have a housing problem. We have a priority and education problem.
Yeah.
I want to think about that for a minute. So it's interesting. My word of the week this week, if you remember last week on Weekly Update, I used relationship, how important it is to be relational, not transactional. My word Friday is going to be education, educating ourselves, educating buyers, educating sellers, educating products and mortgage and title and insurance, educating on our sphere of influence and leaning in on them to help us grow our business. And so I do think that part of what we try to provide you and I on this particular podcast is just some perspective, because we think every person tuning in will grow their business in 2026. But you better not do exactly what you did last year, because you will get what you got. And so we're going to challenge everybody to educate at a higher level than ever before so that we can educate the consumer. The consumer needs our education because they are reading headlines Foreclosures up 21%. Home prices going down in these four markets. They're reading and they're not reading the rest of the newspaper. Really,
correct.
really important. Tony, what else? What else strikes you as we talk about the kickoff of 2026?
Well, I want to kind of highlight what you just said in a different way. The education, I think the word in 2026 in most of our markets is also going to be affordability. And I think using your word educate, we need to educate. It's almost like we need to be better financial counselors with sellers and buyers as far as helping buyers get in the door with that financing package. We need to know our mortgage rates. We need to know our mortgage products that a seller could offer a buyer to help them get in the house, because it may be that 40-year-old who's never bought a home and they just need a helping hand. The good news is what we're seeing across the board. It looks like property insurance rates are starting to level off. You know, we went through some hurricane challenges, especially in certain parts of our state, and the rates went up, and now it's starting to level back off. The bigger news right now is property tax conversations in every local municipality, and assessments, a lot of happening there. But to me, the asset's performing. It's the values are up. And I am amazed at how many opportunities that we have to help coach our owners who bought a home 10 years ago. And they're saying, my house is worth what? And yeah, it's worth that much. And so there's some opportunity out there for our team to really make a difference for these folks as they evaluate those values out there in the field. That's a big trend in 26 and 27. We're going to hear more and more of as our local municipalities start to evaluate their assessment values to match the market value. That's a big, to highlight your word, education.
Tony, it's interesting. There's two data points that both say 40%, and I think they're somewhat related, but not totally related. 40% of housing is owned by baby boomers. And there's been a theory out there. I'm going to go back to 2019. And I know I've shared this story a time or two. In the fall of 19, when we were preparing our business plan for 2020, is we were predicting the silver tsunami was upon us, where the boomers were going to right size, the boomers were going to take their equity. And what we know is two things happened simultaneously. Number one, COVID, that was the group that was the most, highly sensitive. And then over the course of the next 4 years, all they did was make a ton of money. And so the silver tsunami, the 40% of homes owned by baby boomers, is going to happen.
Yep.
When, I don't know. But if you think about, we were thinking about it in 6.5 years ago in the fall of 19, but the dynamics of the market have changed. So we've talked, there's a huge equity stake out there. And the reason I'm going down this path, I'm going to go back to a conversation, Tony, you and I had probably the last 2 quarters. And I'm going to go back to the conversation that we had. That is one that our chairman, Pat Riley, has been talking about for 3 years, is first-time home buyer, average age of 40. I say to myself, think about those boomers or those millennials that didn't buy 5 years ago and how much money they were not making in the And so Tony and I will support Pat Riley's initiative to parents and grandparents. If you have the ability to help your child or grandchild in a down payment for a home, it does remain the American dream, I believe. I think it will always be one of the top 2 or 3 tools to build generational wealth. Data supports that. And so I just encourage us to think differently, right? If I'm out there as a real estate professional, I'm always talking to the first-time home buyer because they don't have a house to sell. I'm always talking to a renter because I can do the rent versus buy. You better start talking to the baby boomer. Now, my favorite story about the baby boomer is like you go to the baby boomer's house and you're touring it, and the baby boomer says, gosh, I just renovated the house. And you say, when? And they say 1987. So that is a favorite of the baby boomer thought process. What do you think, Tony? Because I think we have to help educate. We talked about a minute ago, but to create some market opportunities in a much more proactive way.
Yeah. Well, we're already seeing that tsunami wave, as you say. The boomers are. One of the agents in Winston-Salem I was talking to the other day just sold a house built in 1980. And she said, guess when the last time the seller touched the house in any kind of renovation was 1980. But to your point, the seller did very well financially, but they had to get very realistic with the price. They had to put perspective on, I've been here, 4 decades, so what should I gain? But the buyer who came in, you have to have a buyer who has an open mind about wanting to renovate a full house. It was a 4-bedroom. It was a pretty big house. That's a big investment, but the buyer was creative, could visualize, and that's exactly what they wanted. It'll probably take this buyer 1 to 2 years to renovate this house completely. But the seller had to reduce their price in order to, you got to make up for that renovation cost that you got, but you're still getting an appreciation. That's the headwinds that we have to figure out with the conversations between those two groups. The buyer wants to really reduce really greatly to renovate. The seller wants to make as much as they can. That's a big gap in there, but they met, and probably the seller in this case got 75% of what she thought she was going to get, but she came out ahead. So pretend you paid $100,000 for it in 1980. You're selling it for $700,000 now. You did pretty good. Well, I thought I should get $900,000. No, you got $250,000.
My neighbor got 780. My neighbor got 780, and mine was nicer. As my father used to say, bears get rich, bulls get rich, and pigs get slaughtered. Right? And again, I think, but one of the things you and I spoke about, and I want to ask you this question. The last 3 years, existing home sales have been about 4 million.
Yeah.
For the past 25 years, that average is like 5.2 million. One of the conversations you and I had 90 days ago, Tony, was it appears that looking at historical numbers, this country will sell 4 million existing homes because people need to buy and sell. When you get to 5 million, I call it the discretionary purchase. I don't have to, but I want to. I bought the wrong house in the euphoria of COVID, right? To your point, I'm 18 miles away and now I got to go down to Bank of America and go to work. Yeah. And so I do think that, that's really kind of important information to think through. So I share that a little bit for us to think about.
Let me comment on that. I'm going to call it the sales pace. Go back to where we started with the listing pace. In the Carolinas and our regions, we were somewhere ending the year between 15 to 25% more active for sale signs in the yards. The buyer pace was positive in 2025, but not at 15 to 25% pace. What I pulled was somewhere between 2% to 10%. So if you've got, let's just pretend the high, if you've got a sales pace of 10% and you got a listing pace of 25%, there is a gap that's impacting a couple things. One is impacting competition. So you got to hit the market right to begin with. Buyers are taking their time versus 3 years ago. They're being very intentional versus emotional, like we talked about. And the monthly supply of inventory, which we haven't talked about, is really balancing out. And it's anywhere, we haven't been lower in any market that I've tracked under 3 months for the first time in about 2 years. But we're really starting to get towards 4. And in some markets, like your hyperlocal, I've seen a couple 6s. So 3 to 6 months. And we've always been trained that that's a very balanced, healthy market where both the buyer and seller are negotiating. The other thing is I'm starting to see some headlines about buyer's market. I don't think we're there, but there are some trends in certain price points, certain areas that you're probably going to have to negotiate a little higher, but we're not in a buyer's market that I'm aware of anywhere. But we're trending sometimes that way. And that's when you got to really know your stats every week or every month, because it could happen in certain price points and areas.
Well, I think to your point, I think in looking at the data that you and I shared with one another, Asheville and the high country are pushing 6. Charlotte is barely over 3. And again,
right.
We will be a broken record for sure. It is hyper local.
Real quick on the mountains, just a kudos to the people in Nashville and the people in the high country surviving that hurricane. I will tell you, of all the strong surges of real estate activity, was the second half of 2025 in the mountains. It looked like a much different market, much healthier, because in the first half of 2025, we were in that recovery mode. And boy, did we see some positive gains. It was fun to see that in the second half, but kudos to everybody who lives in those markets. God knows what it's like to go through a hurricane, but they have recovered in a good way and moving in the right direction. And the markets are starting to speak to that as well. So just a shout out to our folks in the mountains.
Yeah, an incredible, resilient response to a tragedy. A couple things, a little off script a little bit, Tony. I know that Dave Childers, who's one of our favorites, and I think one of many of our listeners' favorites, he did an exercise at an event we had, and he said, I want everybody to pull out their phone. And he said, how many contacts do you have in your phone? Whatever. We all have a lot. Some that we touch frequently, some we don't even know who they are, right? Number one, to everybody, clean that up. That would be a takeaway. Database is the key to, I say your database is your retirement, it's your currency, and it's the singular most significant thing you can pay attention to in 26.
Right.
And what's interesting, Dave says 5% of every name in your phone will buy or sell this year. So just think about, now the problem is you don't know which 5.
Right.
Challenging your database. The other interesting number that I saw is 90% of the prospective buyers, there was a group of people polled, prospective buyers. 90% of the prospective buyers, as identified by themselves, said, I'm going to buy in 2026. I'm going to buy a house in 2026. And so if you just take those two things, buyers are going to be more, they're going to be a little more patient, Tony, right? Because they can be. They got more choices. They don't have to do it in a day, etc. Again, I think that this information is so critically important to understand, but then understand how you can use it with buyers and sellers to get them to think and or rethink about their current situation. And again, we talked about it earlier, whether it's a home physical or what they call a PAIR, professional equity assessment report. I think that in 2026, if I were out listing and selling every day like I did years ago, I would make it a point to do a home physical or a PAIR every single year. Even if that's just simply running a market study, a market analysis, and mailing it to my sphere. The consumer buyer seller today must be better educated by us than others that are not experts. And I'm going to just really challenge every single person listening, every single real estate professional. Think about doing what you do a little bit different. And we've thrown around a lot of ideas today. Take 1 or 2. Don't take the 10, take 1 or 2. Tony, what else? Let's talk about interest rates. We talked about a little bit. The big question is, will it start with a 5 at some point in 2026?
Well, my gut instinct is yes. I have heard 2 agents in the last week lock their clients in below 6 for the first time. There were 2 moments, September of 2024 and September of 2025, where we saw that happen for like 1 or 2 weeks. But now I'm starting to hear, no, with the right credit, with the right score, we're starting to see it. I think we got down to 6.1 about 2 weeks ago. So we are really close to being just under 6% into the 5s. Everything I read says it should get to about 5.5 sometime this year, but you never know. We'll see. But I think the potential to get into the 5s right now is strong. And I think, again, if I go back to our comments about seller concessions, you definitely can buy a rate down into the sixes at a pretty good rate, in my opinion, meaning a good cost investment. Well, why not negotiate that in the contract and get down in there? And I do think, to your point, I think that's going to pull a lot of people out into the market again this year.
What they say is if interest rates drop 1% from where it sits today, 5.5 million fence sitters get off the fence. So my only recommendation to everybody is don't wait for it to start with a 5 to get in the game.
That's right.
It's interesting. I read this morning and it reminded me of our conversation, Tony. The best time to plant a tree was 20 years ago. The second best time is today. And so the best time to buy a house would have been 20 years ago. The second best time is today. And again, I think we think the market's going to be an opportunity. Pricing is really critically important. You and I have talked about that. The second a podcast in a row. Let's wrap a bow around it, Tony. We've gone 55 minutes. You and I could go for another 55 minutes. I enjoy talking to you about our business, your passion for it, your knowledge about it, your commitment to our people, commitment to the community. Tony just spoke to a couple groups this week, whether it be home builders or community advocate groups. How do we educate? Again, we've been pounding education, and both he and I need to continue to get out in the market and try to help all of us. One final takeaway for our listener today, Tony. Thanks for being with me. Always a treat.
My pleasure. Thanks for having me. I go back to where we started. It's actually fun to be in a healthy market, and I know there are a lot of our agents who started their careers in 21, 22, and there's some of those agents are struggling right now because they've never been in a healthy, balanced market. But to me, it's fun when you have a buyer and seller both sitting at the table. So my only advice is just like those buyers, everybody be more intentional, be more aware, stay in flow with your clients, like you talked about, Gary, with your database. I think the more we educate people on the opportunities, I think buy a house when you need to buy a house, sell a house when you need to sell a house. Because you cannot time this stuff. I've done it. I personally have tried to time a mortgage rate on a refinance, and I said, nope, I'm going to wait, and I paid the price. Do it when it's right. And I do think this is going to be a good year for everybody. A lot of uncertainty in the world is kind of out between elections, economic issues. The job growth has been really good in the Carolinas. I think a lot of people feel very confident this year. And as we get into a very healthy 6% mortgage rate and maybe below, you really have some good opportunities to get out there and talk and position yourself differently. So let's go get it. I think 26 is going to be a good year.
Awesome. It's interesting. You made mention about business development in the Carolinas. North Carolina made a record-breaking announcement over the course of 25, 330,000 new jobs and $23 billion of investments they've made to bring businesses into our great market area. So a couple takeaways. If you've got a business journal in your market, read it cover to cover, chapter to verse, right? Because it does provide opportunities. It'll be about a new subdivision coming or a new company coming into town. Stay informed. I talked about database a minute ago, Tony. Your database is not just a list. It's your ecosystem. It's your retirement. And it's your most valuable currency. And then I love this, and I'll leave it with this. Calendar equals strategy. If your earning hours aren't blocked, you're simply not serious about this business.
Yeah.
So I echo Tony. 26 is a year of opportunity. I'm going to leave you with two more stats that Tony and I talked about that to me says I'm going to win 2026. NAR just released a study. 71.6% of every licensee in NAR did not do a deal last year. And only 86% did 4 or less. The business is there, serious, the intentional, the focused, and those with a plan. It is there to be had. It goes on to say a belief that 30% of those individuals of the 71 won't be here in 24 months. I know the folks that are listening from our company are in that other set of percentages. And we know that we're going to lean in on this opportunity that 26 has in store for us. So, Tony, Jarrett, appreciate the wrap up of 2025 and a little bit of a kickoff for 2026. Always a pleasure. To our listeners, we'll see you in about 90, or we'll hear you in about, you'll hear us in about 90 days. Be safe. Another winter wonderland coming in. DJ, I'll see you soon, partner.
Thanks for having me. Take
care.
care.
Man.